What is maintenance margin, and how does it relate to margin calls? Have you ever wondered how maintenance margin works and why it is so important in trading? Let's break it down in a way that makes sense. Maintenance margin is the minimum amount of equity that an investor must keep in their margin account after buying securities on margin. This is not just a random number. It represents a required percentage of the total investment value that must stay in the account to keep the position open. When you buy stocks or options on margin, you start with something called the initial margin. For example, if the initial margin requirement is 50%, you need to provide half of the purchase price in cash or securities. The rest is borrowed from your broker. After this initial purchase, the maintenance margin requirement is usually lower, often around 25 to 40%, depending on your brokerage and regulatory rules. Now, here's where it gets interesting. If the value of your securities drops and your equity falls below that maintenance margin level, your broker will issue a margin call. A margin call is a request for you to deposit more funds or securities to bring your account equity back up to the required maintenance margin. If you don't meet this margin call, your broker may liquidate some or all of your holdings to restore compliance. In the context of options trading and risk management, understanding maintenance margin is essential. Options can be highly leveraged and volatile, which means that brokers often set maintenance margin requirements to ensure you have enough equity to cover potential losses. This is where adjusting your positions based on market changes comes into play. If you see a downturn, you might consider closing or hedging losing trades to maintain sufficient equity above the maintenance margin threshold. By actively managing your positions and being aware of market conditions, you can avoid margin calls and the risk of forced liquidation. This proactive approach to risk management is key in both stock and options trading. Remember, maintaining your equity above the maintenance margin is not just about avoiding margin calls. It's about ensuring you can continue to trade effectively and confidently in the market.